I'm just going to greet everybody. Hi, we are having some technical difficulties, as I mentioned, so Bruce is trying to get signed in. So in the meantime, I'm going to stand in and introduce our webinar. So let's go over the agenda for today. So we're going to go over some legislative updates quickly, talk a little bit about our 10-year anniversary. Hopefully you all got to be part of our webinar last week. If you didn't, be on the lookout for the recording. Ebony is putting that together now. And then we're going to get right to the meat of our conversation with the emergency FHA foreclosure prevention update. We have Stacey Tutt with National Housing Law Project, who's going to kind of give us a bit of an overview about the Philadelphia Federal Reserve Bank report and what that might mean. And then Steve Sharpe with National Consumer Law Center is going to talk with us about the details around the FHA COVID-19 relief mortgage options and what it all means in the current environment. And then hopefully we'll have some time to take your questions. So with that, I'm going to hand it right over to Christy Villalobos-Hauser, our Housing Policy Director, to talk about some legislative updates. Christy.
Hello, everyone. Thank you for joining us today. So first on FY 2023 appropriations, the Senate Appropriations Subcommittee released their drafted bill for FY 2023 on July 28th. And this will provide $70 billion towards HUD's programs. Overall, the proposal was $3 billion less than the House bill proposal and $2 billion less than the presidential budget request. This proposal provides $63 million for HUD's Housing Counseling Assistance Program, which is $5.5 million more than the current funding level. And the House provided $70 million towards this program. So it is a little less than the House proposal. So we're meeting with legislative offices to ensure that there is a funding increase this year. We really don't want negotiations to start with Republicans and have this program receive flatline funding, because that is a program cut in the inflationary environment today. It is likely that Congress will enact a continuing resolution to keep the government open on October 1st. And so that's what's happening with FY 2023, and I'll keep you posted on that next time, as well as the budget reconciliation. So yesterday, Senate Democrats passed the Inflation Reduction Act, which is a $740 billion tax, climate, and healthcare reconciliation package. So this bill provides $370 billion for climate change. It also allows the federal health secretary to negotiate prices for certain expensive drugs for Medicare. It included a 3-year extension for the Affordable Care Act subsidies, and a 15% minimum tax on corporations making more than $1 billion in income. So this would provide $3 billion in revenue for the federal government. Overall, this would be the largest investment in clean energy and emissions cut that the Senate has ever passed. And I also want to mention the CRA. Thank you to everyone who submitted comments, especially everyone who submitted comments with the provisions that I emailed everyone. So the CRA, for people who aren't that aware of the CRA, I do want to explain that it is really important. It was enacted in 1977 to eliminate redlining and low to moderate income earning communities. The CRA has strengthened the expectation that banks serve the convenience and needs of local communities. So overall, in May of this year, the Federal Reserve, the FDIC, and the OCC announced that they wanted to adopt changes to this legislation to modernize it and strengthen it. So comments were due on Friday, and we submitted comments that would be So overall, the comments included recognizing lender fee for service payments for housing counseling services by HUD-approved housing counseling agencies as an eligible activity under the CRA. Also, we encourage them to address appraisal bias as new rules are enacted. The appraisal bias recommendation that we included was actually enforced by the Philadelphia Home Appraisal Bias Task Force. So overall, we are encouraging the federal government to include HMDA-like reports that include data on the number and share of appraisal firms provided by the census tract, and with the number of appraised value less than the contract sale price value data. And overall, this would be developed into a list for local cities, counties, and hospitals to use to ensure that they're working with appraisers that have a track record in communities of color and that they aren't understating the property values. We also recommended for credit for CRA eligible activities for housing counseling and financial literacy. And overall, I think Bruce will have more to say on this, but thank you to everyone who submitted comments, and thank you for joining us.
Yeah, thanks, Christy. So Community Investment Act, obviously a lot of groups have weighed in. We really appreciate the leadership of a number of groups in NRC, especially for all the great work they've done in there. And we were very interested in more effectively incorporating CRA in as well. Obviously, we wanted also the big ask, which was that race be specifically considered in the evaluation, race and ethnicity and the evaluations of lender performance. That's why CRA was first created, was really to prevent redlining, and they made it. They did it with their solution was to do it aimed at low and moderate income people. There's a lot of value in that part, but in fact, it hasn't performed nearly as well as we need it to for addressing the issues of race and ethnicity. And that's really what the redlining issue, the most fundamental element of it is. So we joined on with many other groups on that. When Christy mentions that we had that we were going for fee for service payments as an eligible activity under the CRA, partly why that was important was that it's been kind of a gray area about whether lenders might get into trouble on this. Certainly plenty of lenders are doing it currently, so we don't know quite why they're so nervous about it, but there's some concern among some lenders about RESPA issues. It's a pretty standard practice, and banks have done it continuously, and actually all lenders. But anyways, that's the reality, that we've not been able to get some across the finish line on this issue. And there are big projects that are in the works that rely on fee for service. So how do we fix that? So one of the ways would be to have a government document that actually specifically enumerates lender fee for service as a tool for appropriate work, and that may give some comfort to some lenders. A lot of groups jumped on that along with us, so we're really pleased about how everybody was working together on this, and national groups, as well as a number of the local counseling agencies and a number of the state networks. I'm thinking I'm sure I'm going to leave some out, but I do know about Florida and Maryland and Illinois had all I think embraced this, and hopefully others did as well. But very, very helpful. I think it was really a group effort, and appreciate all the good work everybody did on this. Just quick shout out to everybody that contributed and participated in our 10th anniversary. This is really a big deal. It was a really lovely, warm, fun couple hours. And so, we're sending the link out. Ebony will send the link out shortly if it's not already out. Feel free to dip in and take a look. I thought the first half was great, hearing about what people really remembered out of the NHRC work over the years. And our team put together a nice slideshow of some parts of our work. That was pretty interesting. And then the second half, we really kind of talked about where do we go from here and what should we be working on. And so you get to hear a lot of familiar voices, but we also had David Berenbaum. We also had some folks that aren't on our calls as often. And we had lots and lots of participation on the chat line that Ellie told us about as well. So, it was really nice. So big thanks for everybody. We're going to do things throughout the year. And Ebony's working on things on social media. But, it's great to have gotten this far. We didn't know if this experiment would work, and here we are. So obviously our work is not done, and we're going to move into the rest of it shortly, and there'll be more to come. Okay, with that, nice thank you to everybody. Let's move on to the main topic. And Ellie, you want to take it from here?
Sure. Thanks, Bruce. So we wanted to spend some time today just kind of updating everybody about this issue with FHA and the COVID-19 loss mitigation in the high interest rate environment. So I'm not going to delay any further. I'm going to send it right over to Stacey Tutt with the National Housing Law Project. So Stacey, take it away.
Hi, everyone. Good morning, and thank you, Ellie. So as Ellie just mentioned, I'm Stacey Tutt. I'm with the National Housing Law Project. And the reason that we wanted to be here with you today is really just to share with you some of what we're seeing in modification trends, especially now that we are looking at the rising interest rates and how that may be impacting our borrowers. And then to open it up for more discussion and questions too, as we think about strategies in order to help our homeowners in these circumstances. And so if we can go ahead and advance the slide. So first, I just wanted to, put us all of this in perspective as to what we're trying to achieve here and why rising interest rates are impacting our homeowners in these circumstances. As I'm sure most of you know, with FHA and the loss mitigation options that are there, for our current owner-occupant borrowers that are in need of assistance, if they are unable to resume their pre-forbearance mortgage payments, so if they've been struggling with that and no longer can afford those, then they may be eligible for a COVID-19 recovery modification. However, when we look at those recovery modification options that are available, what the interest rate is on those modification payments are tied to the PMMS rate. But also tied with that is the requirement that the borrowers be provided a lower monthly payment than what they had prior to that, and seeing that reduction in their payments. And regrettably, because the modifications are tied to that interest rate and those interest rates are rising, it is getting more and more difficult for homeowners to achieve that reduction in their payment and be able then to be approved for a modification. This even includes the fact that FHA did extend out modification terms up to 40 years. Even with that adjustment, there remain concerns about how many homeowners may qualify for that loan modification option under the current FHA as types and regulations as to the modifications that are offered. So first, we're looking at it through that lens of what's happening to our FHA borrowers. And in particular, we're really concerned about our FHA borrowers because most of the mortgages made to those borrowers are for low and moderate income homeowners. And so they are a particularly vulnerable population during these trying economic times. So in addition to looking at the FHA loss mitigation options, we're also concerned, we can go ahead and advance our slide here, about what's happening to our borrowers with VA mortgages. And what are their loss mitigation options that are available. So again, when looking at VA and what their options are available to homeowners, obviously the first question in looking at homeowners coming off of forbearance for VA is whether or not they can resume their former payments and if that is achievable. If it's not, then the next step in their waterfall analysis again is to look at whether or not a homeowner then would qualify for the COVID-19 modification. But again, much like FHA, there are these requirements with the modification of trying to achieve a lower payment for the homeowners and something that would be affordable for them. And again, concerns about modifications being tied to the PMM rates and the fact that those rising interest rates may make it difficult for our borrowers then to achieve those modification options. And so again, this is why we're in particular focused upon FHA and VA loss mitigation options and the impacts on those borrowers in particular. If we could please go to our next slide. So one of our biggest concerns here, and the reason we wanted to talk with you about this today, is that it appears right now that of the mortgages that are in forbearance, 41% of those mortgages are for FHA and VA mortgages. So as you look at this chart here that we're seeing, and just to make it easier for those who may not be able to read that small print on my slides, if we look at this pretty blue color that is on our chart there, those are our FHA and VA mortgages. And what you can see here is that over time, the number and the percentages of mortgages that are coming out of forbearance that are either FHA or VA is getting larger there. And so you can see that on the screen there, especially as we go out and we're looking at what's ahead, looking at September of 2022, October, and November. Now, I would note the last bar that's on there that says December is for December and out, so even farther than that. But again, we are anticipating that there are going to be a higher number of borrowers, and you can see here a greater percentage of the borrowers that are exiting forbearance have an FHA or VA mortgage. And so this is the population in particular that we are very concerned about in these circumstances. And that's also because our projections are showing that it's going to be more challenging for those borrowers to qualify. If we could please go on to the next slide. So what we're seeing here, and this is one of our concerns in particular, is looking at this chart here. In fact, one of our biggest concerns is that you can see the very last line on that chart says FHA COVID-19 recovery modification, and that's with the 40-year term. Now, what we're concerned about here is you can see that only about 12% of those with loan modifications are going to be meeting that principal and interest reduction that would then be achievable for a loss mitigation. And even though FHA has now that 40-year term that is available, you can see that still a really small percentage that may qualify then for the modification without some type of additional assistance and looking at that affordability and those concerns that rest there and achieving again those reductions in order to approve homeowners for that loss mitigation option. So in these circumstances, again, we just wanted to raise this as a concern. And we're also looking at this in the lens of how can the Homeowners Assistance Fund or those half dollars out there that may be available to homeowners be able to work with the other loss mitigation options that are out there and hopefully help these homeowners stay in their homes. So we can go ahead and go on to our next slide. This slide right here that we're showing you is trying to give you an idea of how each of the states are interacting with the Homeowners Assistance Fund and loss mitigation options in particular. Again, as many of you probably are aware, with the Homeowners Assistance Fund, Treasury offered guidance to all of the states on how to design their programs, but then the states had a great deal of flexibility on how they wanted to develop their programs, and many of the states have very state-specific requirements for the Homeowners Assistance Fund. So what this chart is here is just really trying to show you the states that are working and actively engaged in utilizing the Homeowners Assistance Fund dollars with loss mitigation options. In particular, this first column here, the 9 states that are listed there encourage that half is combined with the other loss mitigation options. And in fact, in many states like New York in particular, they're working very hard to combine those dollars to allow homeowners then to qualify for a loss mitigation option. Whereas those that are in this second column here do not require that prior loss mitigation evaluation. And most of these states will rely upon the homeowner's attestations that they have tried to look at loss mitigation options, or that they simply cannot afford the loss mitigation options that are being made available to them. And so you can see there are a significant number of states that fall into that category. Now, as we talk about those, it doesn't mean that the funding cannot be combined with other loss mitigation options. In fact, most of these states say that it can be. And also, if you look at the guidance that's been offered by FHA and VA, they also say that half dollars can be incorporated into any of the other relief in order to help homeowners stay in their homes. So again, this column here with the majority of the states doesn't mean that they won't consider combining half dollars with loss mitigation. It's more that it's not a requirement and it's not within their approval process that they are evaluating that, as much as you will see within this first column of states. And then the last one here is that these states here do require some proof of loss mitigation evaluation. What proof is required by these states does vary. Sometimes they're looking for verification from the servicers. In other instances, such as Illinois, they're looking from a letter from a HUD certified counselor or a legal services organization indicating whether or not the homeowner would benefit from the homeowner's assistance fund and the allocation of that assistance. And so again, we just wanted to share all of this with you because in particular, what we are finding in this area is that in order for homeowners to be able to qualify for these loan modifications, to be able to potentially utilize the homeowner's assistance fund with a loss mitigation option, that an involvement of HUD certified counselors is key. It takes a great deal of coordination, both in communicating with the homeowners and the servicers and HAF administrators to have this all work together. But as you can tell from our earlier slides, it's becoming more and more pressing that we're looking at every option for our homeowners, in particular, those homeowners with FHA or VA mortgages that are going to be coming out of their forbearances here in the near future. So with that, I'm going to go ahead and turn it over to Steve Sharpe from the National Consumer Law Center.
I want to just pipe in really quickly, Stacey, because a housing counselor in New York and a housing counselor in Maine both popped into the chat that their states require the HAF applicants to apply for loss mit before they will be reviewed by underwriting. Yes,
and I apologize. I do appreciate that clarification. This first column here where we say they encourage that is like strictly encouraged. And they actually has to be part of that evaluation itself as they're looking at those options in there. And again, I would reiterate with anybody that is sharing information in here on your direct experiences with the HAF programs, I love it because what we get most of our information from are the term sheets and their websites. So if you have direct experience working with those HAF programs and can provide us with additional insight on how they are operating, we always greatly appreciate that because it helps inform us of what's really happening on the ground in those states.
And I'll add, please make sure that you chat to everyone so that we get a record of it. It seems that if you only chat to the hosts, we don't get a printed record of it. Okay, thanks. Sorry. All right, and as Stacey mentioned, we're going to move to Steve Sharpe now with National Consumer Law Center. So Steve, take it away.
Thanks. And I think my role here is to sort of kind of some big picture items here. I think thanks for Stacey for giving the setting the groundwork. Actually, I think the biggest message here is that never has there been a time where people need housing counselors and legal aid attorneys more, because it is a very challenging environment. So first off, thank you for all your work with helping homeowners, because it's a very challenging and confusing time. Because the interest rate increase is making this so hard, because we are not in a situation where there was real, clear, deep payment relief for people, especially with FHA and VA mortgages, right? I think that is the big takeaway, that interest rate increases have really limited the amount of relief that people can achieve. And that makes everything much harder. One important takeaway, which I just want to make clear, is that 25% reduction target, the 20% for FHA, the 20% reduction target for VA is just that. It is a target. So people should not be declined FHA modifications if you pull all the levers and you still can't achieve a 20% reduction or 25% reduction in income. So that, I mean, it's just really important to understand. And if people are hearing that servicers are declining modifications because they can't reach 25% reduction, that should not be happening. That's not the rule. But what is the issue is that because of rising interest rates, it is hard, maybe impossible in many cases, to achieve that 25% reduction in payment. So just recognize that difference between a target and a cutoff, and we still are dealing with targets here in that case. What I think the hardest situation right now is that borrowers are often having to decide between HAF and loan modification. Now, Stacey pointed out there are these states where there is some ability or facility or kind of structure in place to combine the two, because for people who truly need relief, that would be ideal, where you could have HAF cover some part of the past due amount and then modify the loan to get kind of that combination situation. If you're in states where that's happening, great. I think in many places it is extremely hard to do that combination. So borrowers are really left to choose between HAF and a loan modification. Again, that isn't, I don't think that's in many places necessarily the rule, but that is the practical consequence. Because if you don't have this easy ability to combine the two, then what that leaves you with is kind of having to decide what path to go down. So, and this makes it very hard. It makes it hard for folks. It makes it hard for housing counselors. And it was easier when you had low interest rates, because basically you made the decision between, do I want to keep my loan where it is and just use HAF to start back up? I can afford my current payment, versus no, I can't do that. I really need some sort of payment relief, and I'm going to go down the modification route. Rising interest rates have made that assessment much more difficult. So what I would say is, in these cases, is it really does take a look with the homeowner and a discussion to decide like what is the best path, and being aware that if you have someone who has a very low interest rate now in an FHA or VA or USDA loan, and you're comparing this 3% or 3.5% rate to what they could get with a loan modification, which might bump their rate up to 5.25%, then you really do want to talk to that person about whether HAF is a more appropriate option, because it allows them to retain their interest rate, or whether a standalone partial claim or something using their current payment is a more appropriate approach, because if they go down the modification route, they may be seeing an increase in interest rate, and that also limits the amount of relief that they can get. So I think that's where this becomes challenging, is in that assessment, and often it's really individual. And again, that presumes that those combinations, this is kind of talking in those states or those spaces where combining HAF and a loan modification is challenging to impossible to do. So I think that's where it gets hard. That's what the kind of highlight is just like, no, just be aware that in the FHA environment right now, many many people are going to be seeing interest rate increases with modifications. And in fact, it's a higher interest rate increase when it's if you're moving to the 40-year product. You get some more payment relief if it's the 40-year, but if you look at the FHA mortgagee letter, the rate is even above PMMS. So that's sort of the message here. And I think, Stacey, do you have anything to add to any of that?
I think that's great.
Yeah, so I mean and that's why we're on the phone. So it is around this Zoom. It's highlighting that very challenging environment we're in right now. So I don't know if that's sort of the key. I will say that one just to note what we've been doing at NCLC. We've seen this problem. These rates have been going up for a few months now. One thing that we have done at NCLC is kind of take this information and kind of use it to base policy analysis on. So we have sent a letter to HUD with some ideas for enhancements to the loan modification product in order to address the rising interest rate environment. One of them is something that I think may take some time to build momentum for, but is allowing for a reduction in the mortgage insurance premium that borrowers pay if it's as part of the loss mitigation process, and then just some technical changes that we do think are enhancements that may unlock a little more payment relief. But it's a hard situation right now. The fact is, where rates are, it makes it harder for borrowers. But these were some suggestions we had. So let me pause there. I do have one other kind of technical issue to touch that Stacey touched on, but I think it may be a good time to pause and see what folks' questions are and other ideas people have.
I jump in with one quick thing. Thank
Absolutely.
you both for tremendous leadership and work here. But it seems like from what you're saying, one of the disconnects is that combining half and the modification. And can a counselor just connect with a servicer and say, we've got a half applicant, we need a modification to match it, and make these things happen? It seems like that's deeply in the interest of the servicer to get essentially a subsidized solution here, and leaving and kind of addressing the problem mechanically, even if they do it loan by loan.
So that has been very challenging to do. And it's really a chicken and egg issue in the states where this is not set up. So the problem is in the writing of the documents, because the servicer is saying, we're not going to build in a 10,000 reduction in our principal balance to account for the half funds unless we actually have that money. And the half administrator is like, well, we're not going to give you the money unless the document is already there. So that is what makes this so hard. It seems like it should be easy, but in fact, it's having to deal with two entities, both wanting the other one to have full, final, complete approval first. And so I'm curious what other counselors say. That was the problem with the hardest hit funds 10 years ago. For those of you who are dealing with it, I was a legal aid attorney then and found it nearly impossible to combine the two then. And in those states now, which don't have specific structures for doing that, it is also hard. And in fact, in some states, this is just not allowed at all. But Stacey, if you have anything to add.
Yeah, I would like to jump in on that because, I would think to that point that you made, Bruce, of trying to combine these in dealing with this struggle, right, of the proper timing. I think one of the ways that I go about it and looking at whether or not it's going to be feasible to achieve this combination of half with a loan modification is one in part making sure I clearly know from the half program what are their requirements. So that's in part why we wanted to share that with you on that screen, that in some states, they are going to want somebody not to qualify for the loan modification and have that shown before they'll even consider them for the $50 because they really want that to be the last resort. Whereas in states with that are really like carefully evaluating that and then actively trying to work in this combined way, so those 9 or so states that are really encouraging that, they have set up more of a system to facilitate that and allow that simultaneous approval. And that's really the very difficult thing to achieve, because what you're going to need the HAF administrator to do is share with the servicer that they would approve individuals for those funds, and then for the servicer to share with the HAF administrator that they will then approve that loan modification, and then work to coordinate that. So all of the documentation that's required to achieve those things, including the signing off on the HAF dollars to then go to the servicers, and then the servicers issuing the loan modification, that requires that significant coordination. And that's where the housing counselors can be really key to making sure that things are getting in timely. They're working with the clients on that. And trying to help with that communication that's already going on between the HAF administrators and the servicers. But again, what we're hearing from those who are working in that area, trying to bring those together, it is very challenging because of the timing and making sure that one is willing to do the other, and that they're willing to work together to make all of that happen in the right time that it needs to, based on all their requirements under RESPA and the regulations for the modification process.
Great. Let's hear from others on this. So I think that this is an area that some advocacy might be helpful as well. So thank you.
So I'm going to take host privilege and ask one question. Ask the first question, which is, so Steve, is there a minimum reduction that FHA or VA will require in order to do the modification?
So there's not, but with the caveat. So, and Stacey alluded to this. One thing, if you're doing folks with VA, two things I want to say about VA. One, and I can try to paste it in. There's a very helpful flow chart for VA if you're working with VA borrowers that you should use. Yeah, Stacey, if you could put it in, that'd be great. And also always reach out to the technician if you're having trouble. VA assigns everyone a technician who's in default. Borrowers are notified of this, but they don't often, but you can look and see, and you can find out who the VA technician is. So I always just like to say those two things when we're dealing with VA. Now back to FHA. FHA does not have, they have a target of 25. It says in the mortgagee letter that borrowers should get whatever mod, an offer of the best possible mod if they have a COVID hardship. The problem is when the payment is set to increase because of the mod, which unfortunately, so this would be the person who is for some reason ineligible for HAF and has probably used up all their partial claim and has had previous mods. You may be in a situation where, and we've heard this from the field, that the best possible deal is, and the deal that the homeowner will want is one that actually increases their interest rate. The problem with that is not, so let's say that's the case, and let's say your homeowner actually wants it. We have been hearing problems in the field, not from an FHA side, but from the CFPB rules, which say you can do a streamlined modification except unless it increases the borrower's payment. So we have heard denials of FHA loans because of increased payment. So not a reduction. Any reduction seems to be okay, but in the increase set. So that's been challenging. My feeling is that borrowers should be able to, in that case, provide some sort of documentation or something to say that this is the best deal. But that hasn't always been happening. So I think that in that case, maybe escalating to the National Servicing Center might be the right thing to do, maybe providing some income documentation. I'm also very interested in hearing how often this is a problem. So if you're seeing this problem, let me know, and trying to figure out ways to work around it. So Ellie, I think that's where we've seen trouble or some tension is in this situation where the only option is an increased payment, but the borrower still wants that. That's where we've seen some issues. But again, that's someone who is for some reason now ineligible for half and has really used up all their other options. So I'm interested in hearing how often that's a problem, and would like to know more about that.
Great. If people are hearing that and you want to pop it into the chat, that would be great. So this isn't a question, it's just a statement from one of our participants, Sheila Hawthorne. I have borrowers who declined loan modification because they want half funds. That leaves them hanging if they're denied the half funds. Then they're out of options and cannot get another loan modification. They'll be forced to sell.
Yeah, I feel you. That this is why it's really hard. What I think this is what makes it hard and why planning up front is so important. I do think that's the value right now, is helping people assess that risk of what the best option is. I think there is at least an argument, though it's challenging, that you could try to ask back for the modification that you rejected if half for some reason doesn't go through. That provides a whole host of other problems, though. I think you're adding more cost, possibly either get a negative interest rate. So I think it is very challenging to deny one and take the other, but you really want to talk through with the borrower, kind of what the cost benefit analysis is here. Because I think that's kind of the challenge of the reality that we're dealing with. I don't know, Stacey, if you have anything else to add on that, but.
No, I agree, Stephen. Regrettably, I think it is a lot about managing expectations and counseling on the risk, because it is risky to reject one offer when there's not a guarantee of the other in these circumstances. And though we can try to project what those approvals are going to be based upon what the requirements are or the waterfall that they are subjected to, as already noted in the chat, I think there's so many variables to that make that particularly challenging. Like, for example, it may take months to get your half application approved. We're seeing that across the nation. So there's no guarantee of when that's going to happen. Also, in these circumstances, and one thing I think we also have to be really leery of when it comes to our half dollars is that each state was provided a set amount of funding in order to, for their programs. And we've actually already seen 2 states, Alaska and Florida, saying that they are completely ending their programs and they're no longer accepting applications. We have other states such as New York, Alabama, Puerto Rico, Rhode Island, Illinois, that have suspended applications for half because they think that they may have already committed those dollars. They may or may not be reopening. We're advocating that they do because their projections aren't showing that they've come to that amount. It is still questionable. And I can tell you in many states, they're suspended or changed. Like Florida came out of nowhere, I would say. Nobody was really expecting that to happen. And as somebody noted, New York closed in February. And we don't know, and they have a wait list, but there's no guarantee then that those homeowners are going to ultimately be eligible for those funds or exactly when they are going to run out. So for counseling purposes, I do encourage housing counselors to monitor in their states what's happening with their half dollars and what those projections are. I just added into the chat a map that's done by NCSHA of the half programs that show those that have suspended their programs or ended their programs. But if you scroll down, you'll also see there's about 20 different dashboards that are out there where you could go and look at your states and see where they're seeing themselves. How much money have they already given out? How much money was allocated to them? And that can give you a sense of where they're at in that process. But it really is uncertain. And so you can't rely on those numbers. You can't rely even on the closures or that they're going to reopen. There's just a lot that's still being processed through the half dollars that I think really, to Steve's point, we need to be counseling homeowners that there are no guarantees in this process and that they may have to make difficult choices in deciding what is the best option for saving their home and being able to remain in it. And I caution people for relying too much on the $50 or any guarantee that they are going to come, because again, we're seeing programs closing or going to wait lists with little or no notice. And that may then again put our borrowers in a precarious position.
So one of the things that I want to bring up was mentioned by Diane Jasso in the comments was around if you're not currently delinquent, you're not eligible for the FHA modification. So I'm just wondering, Steve, if you could comment on that at all. Does the affordability of your current mortgage mean anything in this situation, or is it just, it is what it is?
Yeah, I mean, so that's right. We have not seen HUD say imminent default is a grounds for a modification. So, you know, we have tried to push for that. It has been an uphill battle. So that would help those people. So where would this come up would be people who take half funds and then try to apply for a modification immediately because their payment, because they're saying their payment isn't affordable. We have not seen borrowers be able to do that. We think maybe it should be that way, but frankly, that has not been the case. So that's where it comes up, right? We know that there are clear grounds, or it has been an issue also for people who have modified, you know, that half has not been, haven't been able to then reincorporate half, and that has to do with the idea of like, you'd have to pull the loan out and modify it again. So it's been a problem. So this so the punchline is like this two-step process of like getting one, completing it, and then trying to get the other has not been the case. And so that's been challenging because, you know, ideally you won't want people to like get half and then immediately fall behind. It's terrible, bad for their credit, bad for everything, puts them in tough shape. So the practical answer is no, that has not been happening where you get people with half and then you try to say, oh, but this is still not affordable, like you're just going to reasonably apply. So I think from a planning perspective, you have to be aware of that. And from a policy perspective, we haven't seen a lot of movement on either of those issues, though we've identified this as a problem.
So one of the things I think is important to tell everybody on this call, if you are not already part of a listserv of advocates who are doing half work, please email me or Stacey, and I popped our email addresses into the chat box so that you can get on that listserv. And there's, you know, a lot of emails that come out explaining different things and asking some questions and seeking some feedback. And the other aspect of that is that there is a monthly call of state level half advocates where we listen to what everybody is saying. And NHLP and NCLC have a pretty regular meeting with Treasury and, you know, put it out there about what they're seeing, what they're hearing, and what things might need to be addressed. So again, I encourage you, if you aren't already part of that listserv and aren't already participating in those meetings, email myself or Stacey and we'll make sure that you get added. Stacey, you want to add anything about that?
I did actually, because I noticed that Sheila had added in a comment about what's going on in the state of Minnesota and about the opportunity for homeowners maybe to be able to postpone the sheriff sale, but the administrator isn't sharing that information. That's actually a great thing for me to know. And these are things that come up actually in our calls, or we hear about these things. And that's a way maybe I can help all of you, because I'd be happy to advocate with the half administrator in Minnesota to get that information posted, included in the FAQs, make sure homeowners are aware of those options, and to be able to make some changes like that may make your lives easier for your homeowners who are trying to get those half dollars. So please, I'm seeing people put some of their information in the chat. We'd love to have you added on. Or if you're seeing issues like, Sheila just mentioned in Minnesota, where there may be a way I can advocate, let me know that. Shoot me an email and I'd be happy to look at it further and see if we can't help more homeowners get access to the resources that are available to them.
Okay, so here is a question from Diane Chipolone. Hi, Diane. Nice to see your name. Steve, did you say that FHA does not recognize imminent default? I think FHA does allow loss mint review for imminent default, borrowers current or less than 30 days past due. Or was your response limited to not sure if imminent default will be recognized after being brought current by half?
Great point, Diane. The problem is the COVID streamlined options are not available. I think HUD has made it clear, though the mortgagee letter is a little unclear. But my understanding of the interpretation of the mortgagee letter is that COVID loss mitigation, streamlined loan mods, what we've been talking about, is not available under imminent default. Now, you could still apply for FHA HAMP, theoretically, under an imminent default, which is where you have to put a whole financial application in. Also, servicers are not in FHA HAMP mode right now, so you have to go through that. So that's sort of my understanding of the state of play. No, not allowing imminent default evaluations for COVID options. Can still do that for FHA HAMP, but you'd have to do full documentation.
Okay, I think that answers Diane's question. I'm just going to very quickly, folks, if you're putting your name, oh, there you go. Thank you. So just be sure to put your email address in if you want to be added to the list rather than just your name.
I did want to just add in particular for homeowners who may be, and I don't know how true it is in these circumstances, maybe have a temporary reduction in income or things of that nature. There are a number of HAF programs that are providing monthly assistance on a mortgage payment assistance instead of just an arrearage or allowing someone to reinstate their mortgages. And so I would also note that a number of the HAF programs, because of the increase in interest rates, are actually expanding their accessibility to those monthly payment assistance through the HAF dollars. Pennsylvania is one state that just revised their term sheet in June to increase the eligibility for that program and allow more homeowners to access it. So I would also encourage you to look at what your program allows for with the HAF dollars and really be integrating that into the counseling session as well as to that affordability, long-term and short-term, for any of the loss mitigation or HAF options that may be available. And I guess just to say, know that your HAF programs can change and adapt. And so if we advocate with those programs, we may be able to adjust them to homeowner needs, but it's also something then you want to carefully monitor, sign up for updates so you can see any of those changes as they are announced, and hopefully allowing homeowners that greater access to the HAF dollars.
So there's a comment here from Amy Kennedy in Colorado, and I'm going to ask Amy a question before I read this out, because it's the last time I looked, and maybe Stacey, it's changed, but I thought that Colorado was still in a pilot program status. And while you're looking at that, is it? Yeah.
At least that's what's being reported on NCSHA's website. And I have seen states like Oregon that go through phases and they're slowly transitioned and opened. So it is within those states, I do try to carefully monitor where they're at in opening or when homeowners are eligible.
Okay. And so Amy is just saying that it's called EMAP in Colorado. They require a decision or an outcome from the mortgage servicer before giving a decision on their application for monetary assistance. New York does not allow forward payments. There's a lot of requests to add to the listserv. Let's see, do we have, how many states have closed their programs so far?
Well, that have officially designated themselves as closed. We actually only have 2 states that have done that. That includes Florida and Alaska. Though I looked at Florida's numbers of how much they've given out, and it doesn't seem they've committed all of their dollars. So we're continuing to monitor that and what's happening in the state of Florida. And then in addition to that, we have Rhode Island, New York, Illinois, Alabama, and Puerto Rico that have stated that they've suspended or have a wait list now for their applications. And so those are in more of a suspense mode. And then I also believe Minnesota has projected when they are going to close or how long they're going to keep applications open, though that has been extended now a few times. So it's difficult to know for certain when that may be happening in the state of Minnesota. But again, I try to track those dashboards and kind of see what's happening in the on the ground. Because for example, Minnesota will show that their dashboard shows that right now they project 62.8% of the available funds have been applied for. So you can get that kind of information from the dashboards to help you gauge where the HAF program is at.
Great. So somebody did say New York just updated their guidelines and have started forward payments again. Amy Kennedy says that Colorado is in phase 3 or 4. All programs have worked the same for review by the mortgage servicer first and typically 3 to 4 months behind in reviews. And that's the last of our questions. People are starting to message me that they're jumping off because the HUD, Housing Counseling Federal Advisory Committee meeting starts at 1. So Bruce, I don't know if there's anything that you wanted to say in wrap up, or if Stacey or Steve, there's any final things that you want to say. Steve, go ahead.
I just really appreciate it. I'll put my email in the chat. It's a really tough situation, and let us know if there's any questions or we can help. But thank you for all you're doing. It's a really important time to have a housing counselor right now.
And Steve and Stacey are always very responsive. I just want to say they're very responsive, always very helpful. So you should feel free. And I hope that's okay for me to say that. You should feel free to email them and ask them questions. And Bruce, I'll hand it over to you.
Excellent. And thank you very much for all the great work that you're doing and everybody in the field too. We really need to get through all this. So quick reminder about becoming a member of NHRC. It's what keeps us going and does give us the ability to be flexible about our lobbying. And obviously you're supporting the work we're doing. We will continue doing it as much as we can, but this is a critical piece to all this. And a bunch of groups I know are up for membership renewal now, and that's great. And certainly we need new members to come in as well. So thanks for all that good work. There's the credit report discount that hopefully you're getting already, but if not, let us know. We're glad to help you get signed up for that. Good. And with that, we won't have another leaders call until September. So we'll be looking to talk with you then. And it should be a lot of work we're going to be doing this fall. So we're going to be thrilled to talk with you about what the pieces are. We've got we're going to get a report from a number of the leading Hispanic programs around the National State of the Housing Report done by Nhrc and their allies. We'll also do some other interesting things this coming fall. So keep an eye out for all of that. And thank you so much for joining us. We'll be in touch. Bye.